This content is for educational purposes only and does not constitute financial advice. Always do your own research before making investment decisions. Welcome to the parallel economy. What really is money? Is it a shiny piece of metal you can hold in your hand? Is it a piece of paper with a promise from the government printed on it? Or is it something much, much deeper? In this episode, we will go in on a journey from ancient gold to modern Bitcoin to uncover the true nature of money. Stick around, because what you learn might just change how you see the world. To understand where we're going, we first have to understand where we've been. For thousands of years, humans didn't use money at all. We used a system called barter. Imagine you're a farmer who grows wheat, and your neighbor is a blacksmith who makes tools. You need a new plow, and he needs flour to bake bread. Simple enough, right? You trade your grain for his tools, and everyone's happy. But what if the blacksmith doesn't need any more grain? What if he wants salt, but you don't have any? This is called the coincidence of wants problem, and it's a huge limitation of barter. You can't always find someone who has what you want and wants what you have. On top of that, how do you divide a cow if you only need a small tool? And how do you save your grain for the future without it spoiling? This is where money was born. Not from a government or a king, but from a basic human need for a better way to trade. Throughout history, societies around the world instinctively gravitated towards certain materials to solve this problem. Shells, beads, salt, and most famously, metals like gold and silver. Why gold? Because it had all the right properties. It was durable. It doesn't rust or decay. It was portable. A small amount holds a lot of value. It was divisible. You could break it into smaller pieces without losing its worth. It was fungible. One piece of gold is the same as another. And most importantly, it was scarcity. You couldn't just create more of it out of thin air. Scarcity, combined with its universal appeal, created a powerful foundation of trust. Gold became money because everyone agreed it had value. It was a shared belief system, the first global consensus on what constituted wealth. For centuries, this was the bedrock of our economic world. But carrying around bags of heavy metal isn't exactly convenient, especially as trade and economies grew larger and more complex. Imagine trying to buy a house with a cart full of gold coins. It's impractical and risky. This is where the next evolution of money began. People started depositing their gold with trusted third parties, like goldsmiths, who had secure vaults. In return, the goldsmith would give them a paper receipt, an IOU, that certified they owned a certain amount of gold stored in the vault. Slowly, something fascinating happened. Instead of going back to the vault to withdraw their gold for every transaction, people started trading the paper receipts directly. It was just easier. That paper receipt became the money. Why? Because everyone trusted that it could be redeemed for the real thing the gold in the vault had. Anytime. This was the birth of paper money. Early banks operated on this principle, and for a long time, currencies like the US dollar were just claims on a specific amount of gold. If you look at old dollar bills, you'll see phrases like redeemable in gold on demand. The paper wasn't the value. It was just a convenient representation of the value stored safely away. This system, known as the gold standard, anchored the world's financial system for decades. It provided stability because the government couldn't just print more money without having the gold to back it up. But this stability also came with rigidity. It limited a government's ability to manage its economy, especially during times of crisis like wars or recessions. And that brings us to a pivotal moment in monetary history. On August 15, 1971, U.S. President Richard Nixon made a stunning announcement. He declared that the United States would no longer convert dollars to gold at a fixed value. With that one decision, the gold standard was severed. The dollar, and by extension most of the world's currencies, was no longer backed by a physical commodity. So, what backs it now? The simple and perhaps unsettling answer is a promise. This is what we call fiat money. The word fiat comes from Latin, meaning let it be done or by decree. Fiat money has value simply because the government says it does, and because we, the people, collectively agree to accept it as a medium of exchange. Its value is based entirely on trust. Not trust in a physical asset like gold, but trust in the stability and credit of the government that issues it. This system gives central banks immense power. They can increase or decrease the money supply to stimulate the economy, fight inflation, or fund government spending. This flexibility can be a powerful tool, but it also introduces a new kind of risk. If trust in the government falters, or if the central bank prints too much money, the value of that currency can collapse. We've seen this happen time and time again with hyperinflation in countries like Zimbabwe, Venezuela, and the Weimar Republic. The fiat era untethered money from physical reality and anchored it purely in human belief and institutional control. Fast forward to the 21st century. When you think of money today, you probably don't even think of cash. You think of tapping your card, your phone, or clicking a button online. The reality is, the vast majority of money in our world, over 90%, doesn't exist as physical cash or coins. It exists only as digital entries on computer servers in banks. When you take out a loan from a bank to buy a car or a house, the bank doesn't take physical cash from its vault and hand it to you. It simply types numbers into your account. Poof! New money is created out of thin air as digital debt. Your loan becomes an asset on the bank's balance sheet, and the digital dollars in your account become a liability. This system of credit creation means that the money supply can expand and contract based on the lending activity of commercial banks. We've moved from physical gold to paper representing gold, to paper backed by nothing, and now to digital entries backed by promises. Each step has made money more abstract, more efficient, and more centrally controlled. But what if there was another way? What if we could have the digital efficiency of modern money combined with the scarcity and trust of gold? In 2008, in the wake of a global financial crisis that shook trust in the banking system to its core, an anonymous person or group published a white paper titled Bitcoin, a peer-to-peer electronic cash system by Satoshi Nakamoto. This was the spark of a revolution. For the first time in history, Bitcoin proposed a form of money that could exist without any central authority. No government, no bank, no CEO. Its rules are not set by politicians or central bankers, but by mathematics and code. Its supply is fixed and predictable. We know there will only ever be 21 million Bitcoin. It cannot be debased or printed at will. Transactions are verified and secured not by a single company, but by a global, decentralized network of computers. This is the technology we call blockchain. Bitcoin's breakthrough wasn't just creating a digital currency. It was solving the problem of trust in a digital world without needing a trusted middleman. It replaced trust in institutions with trust in cryptography and open source code. So here we are today, living in a fascinating moment in history. We have two monetary systems operating in parallel. On one side, we have the traditional financial system, or TradFi, built on fiat currencies controlled by central banks and governments. It's a system based on trust in institutions. On the other side, we have the emerging world of decentralized finance, or DeFi, built on cryptocurrencies like Bitcoin. It's a system based on trust in mathematics and verifiable code. One system can print money infinitely. The other has a fixed, unchangeable supply. One relies on top-down authority. The other operates through bottom-up consensus. This is the parallel economy, a bank vault versus a digital wallet on your phone, a government decree versus an algorithm. So, after this journey, let's return to our original question. What is money, really? As we've seen, it's not the gold, not the paper, and not the numbers on the screen. Those are just technologies, different vessels that have carried value through time. The true essence of money is belief. It is a social contract. It is the shared confidence that what you hold today will be accepted by someone else for goods and services tomorrow. From gold to fiat to Bitcoin, the underlying principle has always been about establishing a common language of trust to facilitate human cooperation. Bitcoin and the world of crypto aren't just creating new assets. They are fundamentally challenging our existing belief system about where that trust should be placed. They offer an alternative, a new kind of trust for a digital age. The evolution of money is far from over. We're living through the next major chapter right now. The principles of value, trust, and exchange remain the same, but they are being rebuilt on new digital rails. Thanks for joining us on this journey. If you want to dive deeper into how traditional finance and the new world of crypto connect and collide, make sure to subscribe for more insights. This is the Parallel Economy. We'll see you in the next episode.